Investor panic. Tariffs threatening financial stability, Rick. As we think about all the different buckets that investors can put their hard earned dollars into, a wide range of asset classes are declining in value as we speak. We're 6 days out from the release of the tariffs, and it is bordering on controlled instability.
I think we're going to have to copyright that phrase, Jeff, controlled instability.
There you go.
Uh, it's a really difficult time to be an investor. And if you watch any of the cable news networks that focus on investing in the stock market, they're urging people to stay calm and to be very selective about investments. While the stock market has come down significantly in the last week, as you mentioned. Um, that presents buying opportunities for savvy investors. And what the analysts are suggesting is that the market probably hasn't fallen enough that you want to just go buy index funds. But if you're following certain companies that have probably been unrealistically knocked down in terms of value, this is probably a good buying opportunity for some of those types of companies because they'll probably come back faster. But the general rule of thumb is just stay where you were and ride this down and ride it back up because it's almost impossible to time the market. And the broader concern for us, Jeff, is in some of the ancillary fallout from what we're seeing in the stock market. Bank stocks are taking a disproportionately hard hit. We've seen trillions of dollars in capital vaporize overnight. Could that ultimately lead to a liquidity crisis when it comes to investors being able to get the capital they need to buy properties, whether it's for the purpose of reselling them or holding onto them as rentals? It even gets down to companies like RCN and their ability to continue to raise capital to make these loans. So those are the kind of things we have to watch. You know, historically speaking, large tariffs have been followed typically by short-term unemployment and longer-term inflation. And if those two things do take place in the United States over the coming months, that could certainly have some implications for the housing market and for real estate investment strategies.
So I guess if we're going to talk about a wider bucket of investment classes, what sectors are most vulnerable to these tariff changes? I mean, we're real estate investors, lenders. We think about the increased cost, certainly that along with the diminished labor supply. But my guess is there's lots of sectors that are vulnerable to these tariff changes.
Yeah, the sectors that are probably most vulnerable are sectors where there's very little U.S. manufacturing involved in the completed product, and from countries where the reciprocal tariffs, as the Trump administration is referring to them, are going to be significantly higher. Vietnam, for example, where we get a lot of textile goods, a lot of clothing, things like that. We're talking about tariffs that could be in the 40-50% range that dramatically inflate costs or conceivably cause consumers to stop buying those products. The automotive industry is particularly vulnerable, and we're seeing the manufacturers, the GMs and the Fords of the world talk about moving more assembly back into U.S. plants to avoid paying some of these tariffs. The housing market, interestingly enough, probably isn't as directly impacted by the tariffs, at least in the short term, as some other markets are. Longer term, if the tariffs stay put and stay in place at these higher levels, we're going to see builders have to factor in higher costs, and some of the estimates have been anywhere from ten to $12,000 higher cost per home because of the cost of imported goods like drywall, flooring, and lumber from countries where they're likely to be higher than normal tariffs. So all of this does factor in, but from again going back to a housing market perspective, if we don't see a dramatic drop off in economic growth, if we don't see a dramatic increase in unemployment, we continue to see a relatively stable economy. That bodes well for housing, both in terms of owner-occupied properties, so home sales, and in terms of rental activity. So the hope is that we don't see the worst of the fallout that some of the prognosticators are predicting.
So, for our investor audience out there, especially our real estate investors, how do we think about ways now that these tariffs are on the table and they're going to be implemented over the coming weeks and months? How do we think about ways for our investor customers to mitigate as many risks as possible?
Well, the most fundamental way, Jeff, is to sharpen your pencil a little bit more than you usually do. If your usual rule of thumb is don't pay more than 70% of estimated market value on a property in order to make sure you have enough margins, maybe you need to drop that down a few points and start looking to buy a little bit more of a discount. Maybe take a look at market trends in the regions where you do business. Is your market a market where employment could be at more risk because of some of these tariffs and the after effects? Or is it a market that could be experiencing growth because, say, a Ford or a GM is going to increase the number of shifts at the local assembly plant? So you're going to have to actually play armchair economist a little bit as we go through this, or tune into more of our episodes of these RCN minisodes because we're going to be following this for the foreseeable future.
Appreciate the update, Rick.